Okay, the purpose of this video is to walk you through the more complex model that we use in the San Jose office. And this model in part is going to build upon the model that was described in one of the earlier videos, and it was described as the intermediate model. So in this more complicated, what I'll call set of models, there's actually 4 files. And you can see here I've pulled up my Excel, the tab that shows the different Excel files I have open, and there's actually 4 files that make up this global consolidated provision template. Okay, so the 4 files, and it'll scale depending on the number of entities that you're going to consolidate, but the way I'm going to show it here is to include 4 files. So the first file is going to be the US provision, and that Excel file is going to look a lot like the domestic provision template that I showed you in the earlier video. Again, that was called the intermediate provision template. It's going to look very similar with one exception, and in a minute I'll show you the one exception. The second file, at least as it's shown here sequentially on my screen, is the worldwide consolidation tool. And once we've done a US provision, a non-US provision, and we've populated our FIN48 workbook, we'll use the worldwide consolidation file to bring everything together. Okay, and I'll show you that towards the end of the video. The third file open on the menu here is the FIN48 workbook. So for more complicated provisions, we tend to use a standalone FIN48 tracking tool and take the output of that and pull that into the we actually pull it into the US provision, which then goes into the consolidation. And then finally, the 4th file in the series here is just an example of a non-US provision pack. And what we typically do when we use this model is we'll have a separate Excel workbook for each non-US entity that's the subject of a standalone provision. So it's common that in some worldwide provisions we scope certain entities in and we do a complete provision. With other entities, they're so small we don't. We typically will use this tax pack for any entities that are considered in scope. Okay? So those are the 4 files: a US provision, a consolidation tool, a FIN48 workbook, and then non-US packs. And there'll be times where we'll have 20, 30, 40 non-US packs, and I'll show you in a minute how the consolidation tool can scale for that. Okay. One overall comment: this is just Excel, like the other 2 templates that I've shown by way of video. So you can change just about anything that you'd like to modify the templates to your liking. Some of this is fairly automated, but it's not perfect, and so keep in mind that there's nothing locked, there's nothing cast in stone here in terms of these templates. Okay, so let's start with the US model. And what I'm going to do is, in cleaning out these models from one of the client templates that we've used, we left certain numbers in just to show the flow. And so that I keep this video shorter than it would be if I actually did a provision for you in the video. I'm not going to populate it as we go. I'm just going to show you the various tabs with the numbers already pre-populated. And what we'll do is the Excel files that we'll share will be the exact file that I'm showing here, so that the numbers on this video will look similar to the numbers in the schedules that you receive. Okay, so again, we're going to start with the US provision model. And like I said, this is almost the same as the intermediate provision template that we showed in a separate video. The one difference is, instead of the results of the provision ultimately flowing up to a 10K footnote tab or series of tabs that would populate the tables that would go in your 10K disclosure, this US provision flows up to what is called the output tab. Okay? And what we have on the output tab is just some very basic data which explains the answer, if you will, for the provision. And so there is a column for federal and a column for state. And what these columns both do is they walk through the two tables that are going to go in your 10K disclosure. The first one being the calculation of the current and deferred provision. So in this example, I have an entity that has 10 million of book income. Its current provision is 5.4 million. Its deferred provision is 98,000, which is a benefit in this example. And the total provision is 5.3. Okay? So that's the first item that sums up out of this provision model. And then the second thing is a table that summarizes the deferred tax assets for both the current year and the prior year. Okay, and so remember, this column with the numbers in it, that's our federal column. So this would be our federal deferreds for the current year and our federal deferreds for the prior year. Okay, and that change in deferreds becomes my deferred provision up here. So what you're going to see is that this column, remember I have a column for both federal and state, what we're going to do with this column is we're going to manually pull it into our consolidation workbook. And it's this data for every jurisdiction that we're going to gather. We're going to gather in a consistent format, and then we're going to consolidate it, put it into dollars to the extent that any of the entities are not in the functional currency of dollar. So again, the one difference between this model and the domestic provision template you've already seen is this output tab. So we don't have 10K disclosure sections in here. We just have this output tab because ultimately we're going to pull this into the consolidation workbook. Okay? I want to show you one other thing in this US provision model before we move on. And that is, if I went to the P-4, so this should look familiar. This is just your typical current calculation. This is where most of the input's going to start. You know, income, perms, temp items. If I go all the way down to the bottom, I have credits, you know, just like I think we did in our earlier examples. But here I have our FIN 48 expense. And I'm accruing that through, at least I'm accruing the current portion of my FIN 48 expense through this P4 tab. It gets just slipped in at the end. Okay? And I think I mentioned earlier that ultimately what we're doing is we're pulling from a separate FIN 48 workbook. And the results of that workbook are going to go onto a summary tab. And that summary tab we're going to pull into this US provision model. So I'm going to click through it now. So you can see that the formula for this cell is pulling from P-7. So let me show you where that's pulling from. So that is pulling from this schedule. And what this schedule is basically doing is it's calculating, well, this schedule isn't actually calculating. This is just the summary schedule from the FIN 48 workbook. You can see that these numbers are all hard-coded. And the reason that's the case is this is the summary page of the FIN 48 workbook, and then we just cut and paste the summary tab, values only, straight into the US provision. So to the extent that the FIN 48 workbook would change, we would change it in that FIN 48 workbook and then pull in a new summary tab. But what this summary tab is basically doing is for both federal, right? You can see the different sections of the provision here. So we have our federal section, our state section, and our non-US. And what it does is, in this column right here, we calculate the change in the UTB year over year, again for each of the three jurisdictions. And then anytime there's a change in the UTB, what this section does over here is tells you what the other side of the journal entry is. Okay, so for federal, for example, it's easy. My R&D credit reserve goes up, and that's a credit to the liability, and then the offsetting debit to balance the entry is provision. Okay. In a case like foreign, so foreign gets a little more complicated because take this reserve, for example. The balance actually went down by 9,000. And if I was to show you the FIN 48 workbook, which I will in a minute, you'll see that that reserve in functional currency, in yen, didn't actually change. So all that changed was the dollar equivalent. And so that reduction in the reserve the offsetting journal entry is actually CTA. And I'll show you where I calculate that later. But ultimately, what this schedule is doing is it tells you what the total provision expense is related to FIN 48. And what we do is take that provision expense, adjust it for this guy right here, which is my Fed effective state. You're going to see I slip that into my deferred provision. So I don't want to book that through current. I want to book that through deferred. So even though that's playing a part in my provision entry right here, in effect what I do here is back it out. So ultimately I take this 2.2 million of provision, which is the sum of this provision column adjusted for that Fed effective state, and I pull that into my P4 tab. Okay? And so remember I was showing you that number right there. Okay, so the moral of the story is this is the same workbook as the US model that you saw before. The major difference is that the output tab is the end answer. And then here, this one just has a bit more horsepower in that it doesn't have its own simplistic FIN 48 tracking schedule. It's bringing in the summary tab from our FIN 48 workbook. Okay. All right, so let me next show you our FIN 48 workbook. Okay, so the FIN 48 workbook has, I would say that there's probably 4 main tabs that you need to worry about here. The first tab that's important is this provision input tab. And this should look familiar because this is that summary tab I was just showing you in the US provision model. Okay? And you should see that, for example, if you were following the numbers before, that total provision of 2.2, it's the same provision there. And again, our same jurisdictions, federal, state, non-US. Okay? So this tab is pulling from the separate tabs which track federal, state, and foreign. And again, we gather everything on this page in a way that shows a balanced journal entry for every row. So if you were to go every row through this schedule, you would first see what's my change in FIN 48 balance, what's my change in the UTB, and then what's my balancing entry. Okay? And we've only partially populated this schedule just to show the flow, but as you can see on the right-hand side of the schedule, there's a number of columns that could stand for different balances that we might book a journal entry to. And the more complicated the provision gets, the more populated this model can be. Okay? So again, this is the summary tab that's pulling from the different sections. So if you went into the formulas for the different cells, you would see that it's pulling from the tabs, which I'll show you in a second. So if we went to the federal tab next, what you will see is that we have a row for each FIN 48 position. And for each FIN 48 position, we'll have a column for every year that we have a UTB. Okay, so in this example, we have 3 years. But for a mature company, we might have 10 or 15 columns to the extent that the statutes are open. And we might have R&D credit reserves for this year, and that year, and this year, and things could really accumulate. So the general format that we use is a position has its row, and there's a reserve in every column that stands for a separate tax year. Okay? Once we populate the row for every tax year there's a reserve, these columns will summarize what that total reserve balance is in aggregate. So this is just summing up these. And this section right here, the 2012 balance, when you compare it to the 2011 balance, which we can just pull from the prior year, that will allow us to define what our change in the UTB is. So in this example, because I had no reserves last year, and I do have a balance this year, then my change in the balance is $200,000. Okay? And you can't see it just because of the way the screen's formatted, but when I slide over, what you'll see is just like that summary tab, each of the tabs for federal, state, and foreign, each of the more detailed tabs, they also show these additional columns so that we can see the other side of the journal entry when we change our UTB balance. Okay, so again, with the data that we've populated in this model, it's straightforward. The reserve's going up, and the other side of the entry is provision. Okay. Next tab is the state tab. It works exactly the same. Probably the only difference on this tab from federal is because there's a Fed effective state. You'll see that one aspect of the journal entry will be that there'll be a Fed effective state DTA entry to go along with the change in the UTB. Okay, so our UTBs are kept at gross, which we're going to need that for disclosure purposes. But ultimately, we explain a balanced journal entry, and we explain the Fed provision, or sorry, the state FIN 48 provision effect as being net of Fed. Okay, so then the last key tab is the non-US provision tab, and you should start thinking that this formatting looks pretty similar between the Fed, state, and foreign. And that's right. I mean, every row, again, is a position, and every column is a year, which could reflect a year in which that position has a UTB. And then we sum up the balances for the years, etc. So if I slide over on this schedule, you'll see it's exactly the same as the other ones, right? We get to a change in the UTB, and then we show how we balance our journal entry. The one thing that's a bit unique about the non-US tab is you can see in this formula on the screen, this is pulling from this non-US reserve and FC tab. And as the formula would suggest, this is pulling from some source data which is kept in functional currency. And so we keep our reserves in functional currency. And so you can see on this column right here, we have an indicator for what the functional currency is. So the source data is going to be pulling from a tab that will have yen for this first row and Korean won for the next two rows. Okay? So if you go to the reserve balance here, let me get my cursor back. So if I was going to pick on this number right here, this 102,000. That's my 2011 reserve balance for my Japanese royalty payment UTB. So if I went to my functional currency tab, you can see that I'm keeping that in Japanese yen. And my balance isn't actually changing from 2012 compared to 2011. It's both 10 million yen in both periods. And so if I was to slide over in the screen so you could see that change in the UTB, there is no change in the UTB. So when I come back to my non-US tab in dollars, the fact that there is a change in the UTB, right, because this year it's 102,000 and last year it was 111,000, that decrease of 9, because there's no functional currency change, I know that that balancing entry is going to go to CTA. Okay, so this is pretty simplistic technology to get the CTA aspect of non-USD functional balances correct, but I just want to call that out as something that's a little more advanced than what was certainly in the intermediate provision file. Okay, so in a nutshell, this file has a FIN 48 tracking tool for federal. It has a separate tab for state, and then it has a non-US tracking tab. And it pulls all three of those together in this summary file, gives you a really good snapshot of what's happening for each jurisdiction and for each provision in a balanced journal entry sort of way. And then ultimately it aggregates that into one big global JE for your FIN 48 activity for the year. Okay, and it's from that global JE that we pull the FIN 48 expense and all the balance sheet movement into the U.S. provision, and we record it through the journal entries in the U.S. model. Okay, so if I just went back to the U.S. model just for a second, you should see that in our tax account roll forward file, and this should look familiar because this was something we talked through in the earlier video when we were covering the intermediate model. There's a separate journal entry just for FIN 48, and that is in effect pulling from the P-7 file. You can see it in the formula, and that P-7 formula again, or file, is simply the summary tab that we've lifted out of the FIN 48 workbook, and we've just slipped it into the U.S. provision model. So we book it in the U.S. provision model, and that will then go into our, that'll become part of our U.S. provision, which flows to the output tab. And so now we've captured our FIN 48 expense as part of our U.S. provision. Okay, so at this point I've showed you the U.S. model and then also the FIN 48 workbook. Let me show you a non-U.S. pack. Okay, so this is an example of a, it looks like a Japanese yen functional currency entity, a Japanese foreign subsidiary. But this is a pretty standard pack that we've used for some larger public companies where we've done the global provision for them. And what I would emphasize before actually even hitting the file on this one is we try to keep this pack as simple as possible. We try to make it as absolutely remedial as we can, because this pack tends to get sent to local controllers, and we don't want to complicate the provision beyond what it has to be, just so we minimize the back and forth with the local finance teams in terms of the accuracy of these files. So we tend to tell the finance team to focus only on the blue tabs, which are the first three tabs. And even within that, we tell them to focus on the blue shaded cells, which are input cells. Okay. So this F1 tab that we're on now, this is the current provision equivalent. It's labeled payable, but in effect this is the same thing as the P-4 in our U.S. provision model. This is the current calc. So you can see in the current calc, we start with GAAP income. We have GAAP to stat differences here, so that ultimately we get to statutory income. Okay, and I know this sounds basic, but when we're doing a foreign provision, we don't want to run just from GAAP to taxable income. We want to make sure we understand the bridge to get from GAAP to statutory income first. And some of those items could be permanent, some of them could be temporary. Most often they're the latter. And then the second part of our current provision tab is the stat to tax differences. And these are the differences that we should be able to easily spot from looking at the tax return, and then also the local provision. Okay, and that section takes us down to taxable income and then ultimately to a tax liability. Okay, so this is pretty basic, right? This is just a simple calculation of GAAP income down to taxable income and the tax liability. The second tab is the deferred tax roll forward, and if you've watched the other videos, this looks very similar to the most basic version of our provision template. Again, we've tried to keep this as simple as possible. So this is just a basic roll forward where we track our GAAP to stat deferreds in the top section and our statutory to tax return deferreds in a separate section down here. And to me, it's important to keep those separate. It just gets really confusing when you start bundling them. But in any event, this deferred roll forward is pretty straightforward. You can see that the change here in the current column is going to be automatically pulling. You can see the formula from the F1 tab, which is the current tab. In this file, once you roll forward the deferreds from beginning to end of the year, it will also do your current, non-current, and then get to the tax-affected balances on the far right. Okay? And if you had a valuation allowance, this entity doesn't, but if you had a valuation allowance, you could slip that in at the bottom. Okay, and then the third tab that we would ask the local finance teams to focus on is the proof of the payable. So again, it's really basic, but one of the things that goes wrong so often with foreign provisions is you just can't prove your ending balances. So hopefully by way of the deferred roll forward on the tab that was just shown, we can prove our ending balances in the deferreds by going row by row through the DTA roll forward. But as far as our payable or receivable, that's a tough number to prove unless you actually just go through the source data to prove that it either ties to tax returns filed or tax returns expected to be filed, payments made, etc. And that's what this tab is for. So this tab would take the balance per our payable tab, which was the first tab, and then would attempt to compare that to the different reasons we might have a payable. Okay. And so this one can be really customized depending on what your facts are, but this is nothing more than once we've computed a liability at the end of the year, our payable or receivable balance could be made up of, especially in foreign, it's such a common thing where tax returns tend to get filed on a long, delayed basis. Sometimes the payable or receivable balance can be made up of multiple years, liabilities, and payments. And the point of the schedule is to get the local finance team to prove that their ending balance is correct and can be supported. Okay, so those are the three tabs in the non-US provision pack that are shaded blue, and we ask the local finance team for help with. The green shaded tabs are basically our outputs. So this first tab, footnote Raytrack, this is a summary of our current deferred provision. Okay. So you guys have seen that before, so sorry, there's the current provision. Come right off the F1 tab. This is my deferred provision, which will come from the DTA roll forward, and that'll be my total provision. And then I'll prove I got my total provision right by doing a Raytrack down here at the bottom of the schedule. And again, just based on the simple data I've populated these schedules with, the Raytrack is working. I've got 4.3 million of provision up here. My Raytrack is proving to 4.3. I only have one perm. It's this entertainment expense. Everything's working really smoothly just because the data is so simple. So this tab is my current and deferred provision summary and a Raytrack to show that my model is actually working. But if things are, if you've tailored the model to suit whatever your company's issues are, this should just be automatically working based upon the first three tabs. There shouldn't be anything that's input on this file or on this tab. The next tab in our non-US pack is our account roll forward. And we try to, what we typically do on this tab is compute what we would want the roll forward of the tax accounts to be, get ultimately to our ending computed balance, compare that ending balance to what the company has for an ending balance, and that out will come our adjusting journal entry. Okay? So keep in mind, this section here isn't a roll forward of what actually happened. This is a roll forward of what we would like to have happened if we could do the year's provision from scratch. Okay? So this is kind of our utopian case of how we would want to book the journal entries for the year. And at the end of the day, we should get a adjusting journal entry that comes out of that. And importantly, I guess one thing I haven't said so far is going through the non-US pack. We would do this entire provision in functional currency. Okay, so if this is a Japanese subsidiary, this would all be in yen. And the adjusting journal entry that I have highlighted on the screen there, we would expect that to be in yen, just like every other thing in this pack. And then we would tell the company, the local finance team, to book that entry in yen on the local books. So one of the important things behind having a non-US pack for every legal entity is to get that non-US entity's provision correct. Right? Do the provision calculation independently. Don't do any of this consolidation, topside US stuff. We do everything correctly at the entity level. We book the adjusting journal entry in functional currency at the entity level, and so that entity is correct on a standalone basis. The last tab in this section of green tabs is the summary tab, and this is essentially the equivalent of the output tab from the US model that I showed you. And remember that output tab, what it was intended to do was to take some key data in this column. It was intended to take key data in a standard format. So this should, if you remember what I showed you in the US model, this is the exact same format, exact same rows, with no deviation from the US model. And I'm going to take this column, which is essentially the result of my Japanese provision calculation, and I'm going to pull it into my consolidation tab. So remember, this is in yen because everything in this workbook is in yen. But again, it's all the key data I want to be able to consolidate, right? I want to know what my PBT is. I want to know my current provision. I want to know my deferred provision, total provision, and my deferred. If I know all those things for each of my entities, I'm going to be able to consolidate my worldwide provision ultimately. Okay, but the punchline on doing a non-US provision pack, all the tabs we've showed up to this point would help you get the non-US entities provision correct. This tab takes the result and it allows us to lift the answer into a consolidation tool to bring everything together on a worldwide basis. Okay? You got to be really careful that you don't start changing the format of these tabs, because otherwise, as we lift them into our consolidation tab, it's not going to work. Okay? Our consolidation model, although it's well organized, is very simplistic. So the key to it working is that these output tabs have to be very standardized. Okay, so the last file I'll show you then is the Consolidation Workbook. So the Consolidation Workbook, this is the key schedule, if you ask me, in the Consolidation Workbook. And what it does, and by now it should actually look familiar, it takes for every column a jurisdiction, and it takes the data from that output tab, either from the US provision file or from a foreign subsidiary pack, and it pulls itself into its own column as part of this consolidation schedule. Okay? And so, for example, I have my federal column that will come from my US provision. And I got my state column that I pull from the output tab of the US provision. Right? I'm just going to add these across, and that's going to be my US total. My foreign's a little more difficult in that the source for this data, although it's coming ultimately from the non-US pack, you can see that the reference here is the W6. In the W6 tab, which is 2 to the right, the W6 tab is the same data, if you will, but it's in functional currency. So remember that when we did our non-US pack, we did it all in functional currency, and our output tab, our summary tab as it's labeled in the non-US provision file, it's in yen. So we pull that column from the yen, or from the Japanese provision file, we pull it out of that pack and stick it into this tab in functional currency, again in the same exact standardized format. So we literally do just cut and paste to take the output from our Japanese pack and stick it into our consolidation. So this would be the result of cutting and pasting. Okay, that 4326 provision, that might even sound familiar just based on us reviewing the non-US pack a minute ago. So with yen, that's not going to do us any good when we need to translate into dollars. So what we do back on this W4 tab, which is again what I think of as kind of the key tab in this workbook, it will pull, let's just use the Japanese column here as the example. It will pull from the W6 file for each of the rows. So you can see this row is profit before tax, and the formula is pulling from the W6, which is the functional currency equivalent of the same data. But then it translates it with this last part of the formula here. And it's translating using these rates at the top of the screen. Okay, and so obviously we need something to populate these rates. But we have an average rate that we use to calculate the income statement balances. We have beginning and ending rates that we use for the deferred balances, right, the balance sheet accounts. So all this consolidation is doing in dollars is pulling the functional currency amounts from the W6 tab, and that tab is simply the cut and paste values from each of the non-US packs. And then in this W4 for each column, we turn that functional currency stuff into US dollars. Okay, and then if we add up all those columns, right, we add up Japan, we add up Korea. There's nothing in Korea at the moment, but you get the idea. We could just have lots of columns here, all pulling into dollars, and then we would get a sum of our foreign provision in dollars. So if I took the sum of my foreign provision and the sum of my US provision, that would get me my worldwide provision. Okay, and so this schedule, when we've done it for large global companies, oftentimes we have more US jurisdictions if we break out states. And then a lot of times this foreign section will just go on and on and on depending on how many foreign entities that there are. Now note, to the extent that there are foreign subs which we consider out of scope, they're just too small, we still need to patch them into this consolidation because ultimately we want the PBT and the tax expense for the world to be captured on this tab. And so what we do is we have another section off here to the right. You couldn't see it a second ago, but you should be able to see it now. For any entities that are out of scope, we also complete this data, but usually it's really straightforward. Usually it's just a matter of populating PBT and pulling in the expense. We won't typically have deferreds. That's for the reason why the entity is out of scope. So there's usually very little data here, but know that you need this. You need it so that your PBT for the world is all accounted for, and the same for your total expense. Okay? So we capture this data on the W7 tab, which is identical to the W6. And this is just a in this example we have Malaysia and Taiwan. These are non-scoped in entities where we would we'd really just hard code this data right off the GL so that we were matching. Okay? And again, this would be repetitive, but again, the reason we do that is we want this W4 file, we want it to sum up for the world. Okay? So when we get to our worldwide consolidation column, for example, that PBT number right there, we want that to tie to our 10K. And that 5.6 of total provision, we want that to tie to our 10K. We want that to be inclusive for everything worldwide. Okay, and the same thing down the schedule through the deferred assets, current year and prior year. Okay, so I like this W4 tab because it's a really easy review tool. If you wanted to pick up a large global provision and see, hey, what jurisdictions are really contributing to my provision, my balance sheet accounts, or at least my deferreds, this is a great tab to look at because you can just quickly scan the columns to see where the material entities are at. And to the extent there's a material entity that interests you, then you can go to that underlying tax pack, whether it's US or foreign, to try to understand that provision in more detail. Okay, but this will be a good place to start to see what's material. So once you got the W4 working, right, you're pulling in all that data from your output tabs in either your US pack or your non-US packs, and you're turning it into dollars and you're adding it all up. Once you have that, then what you will see off to the very far left on this workbook is the same 10K footnote tabs that are in the US standalone model, but now these are just designed for a global provision. So these tabs are now pulling from the W4. You can see all the formulas pulling from the W4. It's pulling worldwide data, not just US data. And that's why we can capture, right, in this example, we can capture our federal current deferred, our state current deferred, our foreign, right? It's just, it knows it's pulling from different sections of the W4 because the W4 is capturing the world, but it's capturing it by segment. And it's also capturing current and deferred provisions separately. So the data on that, and the data on those output sheets that then consolidate in the W4, it lends itself perfectly to populate the disclosure. The next tab is the Raytrack, as well as the table of deferred tax assets and liabilities. And again, that's just pulling straight from the W4 schedule. So all these formulas, well, this one's actually coming from the W2. I'll show you that in a second. But if you went to this deferred balance, it'd just be pulling from the W4, and the W4 is just adding up each jurisdiction's deferreds, and by the time you get to this tab, you're seeing the worldwide balance in dollars. And then then the last tab is the UTB roll forward. That's actually just pulled from the Fin 48 workbook. There's nothing to consolidate about that, because as you might remember from our Fin 48 workbook, we actually include the world in that workbook by having separate tabs for federal, state, and non-US. So we keep the entire worldwide Fin 48 analysis in one workbook for starters. So this tab is really just a cut and paste from that workbook. So again, you don't really touch this workbook until you're done with the underlying tax packs. There's no point in doing the consolidation until the underlying source data is correct. But once that source data is correct, you'll really want to focus on the W4. Make sure you understand how all the individual jurisdictions are pulling in and how they're getting translated to dollars. And then ultimately how that rolls into the standard 10K disclosure tabs. There's a couple tabs I skipped over here in the interim. You can kind of play around with this model and see what's there for you. There's a Raytrack tab, which I briefly mentioned a second ago. This does similar formatting as the US provision file does for the Raytrack. So this just allows sorting for categorization on the 10K. And again, I think if you played around with this file, you'd see it's pretty intuitive. And then the W3 tab, I find this to be a helpful tab if you want to understand where the balances come from on a consolidated basis. So what I mean by that is, so in this example, the worldwide balance for the company is a $3.8 million payable balance. So that would show up on the 10K. And if you wanted to know, well, where does that come from? Which entities? We would typically create this file. This is the US dollar version of the file. There's a functional currency tab next. But we create this tab to show for each jurisdiction what its different tax account balances are. And ultimately, that should add up to the total balances, which would tie to the 10K. And if somebody said, well, gosh, if you have this big payable, what are the main jurisdictions where the payable is from? This tab would help you spot that quickly. Or if you wanted to understand, where are my current and non-current deferreds by jurisdiction, this would be a great place on a snapshot basis to see that. And if you had, 50 foreign entities that you had scoped in, right, this schedule would be 50 rows long, and although it would start to get a little more difficult to see, all of the data you want to see at your fingertips would be there. So that's really the sum of the workbooks. Like I said, once you get to the W4, which is what's on the screen now, boy, you're almost there. Once you get the W4 working, the last pieces are really just populating these final disclosure schedules, and you're done. So again, in summary, there's 4 provision files that we're going to share as templates. The templates are going to include all the numbers that I've been showing on the screen to the extent that that helps. I know that I went over this really quickly, but what I would do if you're interested in trying to understand these workbooks is just pause the video at different times, play around with the individual packs. Don't try to watch the video from start to finish. Or if you've already done that and want to go back and try to understand the model better, watch it in pieces. And test yourself as you adjust these different files to either customize for your client or to put in new data so you can see how the data flows. But then try to understand how the workbooks at the lower level then ultimately populate the worldwide consolidation model. Okay, that's it.